Welcome to Iron Financial. Look, if you're trying to forge a stronger portfolio and you want to cut right through the relentless noise and market weakness out there, you are absolutely in the right place. Go ahead and hit that subscribe button right now for no-nonsense market analysis. Today, in this explainer, we're tearing down the fiscal 2026 blueprints of a true legacy consumer staples giant. We're talking about General Mills, ticker symbol GIS. Now, management just reaffirmed their full-year guidance, but when you look at the stock's recent performance and really dig into the underlying SEC filings, we have to ask the hard question. Are we looking at an unyielding defensive fortress here, or is this just a crumbling value trap masquerading as a safe haven?
Seriously, I look at a legacy giant like General Mills trying to navigate this incredibly volatile inflationary market, and I have to ask, is management's reaffirmed guidance actually built on bedrock, or are they constructing their entire fiscal year on sand? Because when a company relies heavily on shifting pieces around the board, buying and selling segments just to hit their numbers, we have to challenge the narrative. Are we seeing real structural durability here, or just temporary accounting illusions?
And that is exactly why we're doing the structural inspection today. I pulled up the Q1 blueprint, and right at the top, the reported diluted earnings per share skyrocketed by 116% to $2.22. On paper, that number looks like solid steel. It absolutely demands attention. But let's be real for a second. Any seasoned trader knows that a triple-digit EPS surge in a mature, slow-moving consumer staples business just isn't organic structural growth. It doesn't happen. It's actually an immediate red flag that demands a forensic unmasking to see what's really holding up the roof.
So to understand that massive EPS surge, we have to unpack the multi-billion-dollar math behind their North American yogurt divestiture. General Mills completely sold off their US and Canadian yogurt businesses. Why? Well, because yogurt had become this heavy, low-margin drag on their overall performance. It required constant, heavy promotional spend literally just to maintain shelf space at the grocery store. Now, this divestiture creates a massive distortion on the top line. If you look at the reported net sales across the first 3 quarters, they show brutal 7 to 8% declines. But that reported drop is masking a much tighter 1 to 3% decline in organic net sales. Think of it like this. They essentially removed a heavy, slow-growing wing of the building. It makes the overall footprint look smaller on paper, but the core structure isn't shrinking nearly as fast as those headline numbers would have you believe.
Hold on a second, though. They sold the U.S. yogurt unit and booked a massive $1.05 billion gain in the first quarter. I have to ask the obvious question here. Is shrinking your business just to print a billion-dollar gain a sign of structural weakness? Are they essentially selling the furniture just to pay the mortgage? Or is this actually a tactical, calculated demolition meant to rebuild a portfolio with stronger, long-term profit margins down the road?
To answer that, we really have to see how this billion-dollar injection warped their actual operating performance. Just look at the sheer gap between the reported numbers and reality on this table. That $1.05 billion divestiture gain artificially inflated their Q1 operating profit by 108%, pushing it all the way to $1.7 billion. But watch what happens when you strip out that one-time gain and adjust for constant currency. And for anyone newer to this, constant currency just means we're stripping out the chaotic volatility of foreign exchange rates to see how the actual physical business performed. When we do that, the true structural reality is exposed. Adjusted operating profit actually fell 18%, down to $711 million. And that highly celebrated 116% surge in diluted EPS? In constant currency adjusted terms, EPS actually plummeted 20%, down to just 86 cents. So the facade was incredibly shiny, but the underlying beams were buckling under pressure.
Right, so that brings us right back to the core question. Is this structural growth, or is it just an accounting trick? Let's completely strip away all the noise. I want to remove the divestiture gains, remove the recent acquisitions, filter out all those constant currency adjustments, and let's inspect the actual load-bearing pillars of the operating segments. What is the true state of the foundation when all the accounting smoke clears?
Okay, let's break down the foundation. North America Retail is without a doubt the heaviest load-bearing pillar of this entire operation. It generated over $8.1 billion in 9-month sales. That makes up roughly 58% of the company's total weight. We are talking about their absolute flagship brands here. Cheerios, Betty Crocker, Pillsbury, Nature Valley. Make no mistake, if this North America Retail pillar cracks, the entire structure is compromised. The rest of the weight is distributed across International at 16%, North America Pet at 14%, and North America Food Service at 12%.
Now let's see how that foundational weight actually translates to third quarter profitability. When we dive deep into the Q3 segment profit variations, the divergence is just massive.
On one side of the building, you have this incredible 82% constant currency structural lift in the international segment. That's largely because they've successfully passed on pricing to consumers in those specific markets. But look at the heavy crumbling happening on the other side. North America food service operating profit collapsed by 32%. And that all-important central pillar we just talked about, North America retail, profits there plummeted 33%. The core of this business is experiencing severe, undeniable margin compression.
Let's actually isolate one specific crack in the foundation that I uncovered in the North America food service segment. This segment reported an 11% sales drop overall in Q3. But when you really drill down into the SEC filings, you find that bakery flour volumes alone accounted for a massive 30 to 35% of that segment's total profit decline. They faced incredibly heady headwinds from market index pricing on bakery flour. Market index pricing basically means their contracts fluctuate directly with the underlying commodity markets. So when grain prices swing wildly, their margins get completely squeezed before they even have a chance to adjust their own selling prices. Now, management claims this specific pressure will recover in Q4, but right now, it is a glaring weakness in their structural integrity.
Okay, and what about the pet segment? Management reported 6 to 11% net sales gains in the pet segment across the recent quarters. But aren't those top-line gains artificially propped up by the recent North American Whitebridge Pet Brands acquisition? I mean, are they just hyping up a turnaround by bolting a shiny new asset onto the side of the house while the original structural foundation continues to rot from the inside?
You know, you are absolutely right to call that out. Because if you look at the raw data for Q3, organic pet sales, which entirely strips out that Whitebridge acquisition, actually dropped 2%. They lagged all channel retail sales growth by 3 full points. But to be fair, they are doing some serious heavy lifting to try and fix it. They are pouring strategic investment into launching their Blue Buffalo Love Made Fresh line into 5,000 retail coolers. They're rolling out these high-margin, stand-up, resealable pouches, which now represent 55% of fresh sales and deliver twice the dollar value of traditional pet food rolls. So it's a very expensive renovation, but it is a highly targeted one.
But as we know, renovations don't hide everything forever. Here's a perfect example of internal structural decay hiding deep within the SEC filings. In the second quarter, General Mills took a $53 million non-cash impairment charge on the Uncle Toby's brand. Now, for anyone unfamiliar with the accounting, a non-cash impairment charge means the company essentially had to stand up and admit that this specific brand is worth $53 million less than they previously claimed on their balance sheet. That usually happens because of permanently lower future sales and profitability projections. It's exactly this kind of hidden foundational decay that reminds us why we absolutely cannot just take headline earnings at face value.
Which brings us right to the core strategy management keeps preaching to Wall Street. CEO Jeff Harmening stated that their focus on executing their, quote, Remarkability Playbook continued to deliver stronger competitiveness. Look, I have to tear into this corporate buzzword. What does a Remarkability Playbook actually mean in the real world? Is it real structural innovation, or is it just really expensive wallpaper? Are they simply burning through massive amounts of cash on promotions and base price adjustments to temporarily buy market share and cover up a cracked foundation?
Let's validate your concern by charting the raw gross margin deterioration, because this is where the true heavy cost of that remarkability is actually felt. In Q1, margins dropped 90 basis points to 33.9%. In Q2, they were down 210 basis points to 34.8%. But in Q3, we saw a brutal collapse of 310 basis points, dragging gross margins all the way down to 30.8%. For those who don't live in the spreadsheets, 310 basis points is over 3%. For a mature, multi-billion-dollar consumer staples giant, 3% evaporating in a single quarter is absolutely massive. It represents a severe structural crack driven directly by high input costs and the highly aggressive price investments they're having to make just to keep consumers buying their products. To explain that margin hit further, General Mills is heavily spending on base shelf price adjustments, rather than just running temporary promotions. A temporary promotion is your standard short-term buy-one-get-one sale or a weekend discount. But a base shelf price adjustment means they are permanently lowering the everyday sticker price on the shelf. They are willingly taking near-term margin pain, literally bleeding out profitability, to successfully hold or gain pound share in 7 of their top 10 U.S. categories. It is a very deliberate strategic choice. They are sacrificing the gross margin ceiling today to ensure the foundational volume doesn't completely collapse in what is a very challenging consumer environment. Now, to offset this margin bleeding, they are aggressively trying to reinforce the pillars. Management's Holistic Margin Management, or HMM, productivity program is explicitly targeting a 5% savings in their cost of goods sold. And look, HMM isn't just a buzzword. In practice, it means executing severe supply chain automation, aggressively sourcing cheaper raw material alternatives, and optimizing packaging to strip out costs. Furthermore, they're driving innovation hard, with over 25% of North America retail sales now coming from new products, like their protein-fortified Cheerios. Add in another $100 million in global transformation efficiency savings, and you start to see the structural reinforcements that are meant to counteract those massive remarkability investments.
Okay, knowing all of this, I really have to challenge their reaffirmed full-year fiscal 26 guidance. Management is essentially promising a notable step up in top and bottom line performance in Q4, leading right into fiscal 2027. But I demand to know, is this structural guidance an unbreakable ceiling? Or is it just fragile glass ready to shatter if inflation ticks back up or consumer demand weakens even further? Do the underlying blueprints actually support this promised recovery?
Well, management is heavily banking on some highly specific Q4 tailwinds to make that happen. First, they project a roughly 200 basis point retailer inventory tailwind. This happens because of a mechanical supply chain lag. The severe retailer inventory drawdowns that mechanically hurt their Q3 shipment volumes are projected to flip back to normalized ordering patterns in Q4. Second, favorable trade expense timing comparisons are going to kick in. Third, they expect that brutal bakery flour volume we discussed to finally recover from the index pricing shock, and finally, the divestiture of the Yoki and Catano brands in Brazil will mechanically enhance their international segment margins simply by removing lower margin weight from the overall portfolio.
However, we absolutely must highlight the forward-looking risks here. Even with those Q4 mechanical tailwinds, labor remains the biggest, heaviest inflationary beam going into 2027. Overall inflation is projected to be roughly in line with this year, meaning the pressure simply isn't letting up. If their 5% productivity savings from the HMM initiatives fail to materialize, that labor inflation will completely crush their bottom line. Make no mistake, General Mills will require relentless, uninterrupted productivity execution just to maintain their basic structural integrity.
So, as investors, we have to weigh these two competing realities. On one side, the defensive yield is very real. They executed $500 million in share repurchases over 9 months, they're successfully holding pound share in their top categories, and they clearly have the pricing power to weather the storm through their remarkability investments.
Right, but on the other side of the scale, the structural decay is completely undeniable. You've got consistently declining organic volumes across major segments and severely shrinking gross margins that, as you showed, collapsed to 30.8% in the third quarter. All right, it's time for a no-nonsense conclusion. We've stripped away the accounting illusions, we've analyzed the 310 basis point margin collapse, and we've fully mapped out the Q4 mechanical tailwinds. Based purely on the forensic math and the structural analysis of the fiscal 26 SE filings, is General Mills an unyielding asset you want to forge into your portfolio, or is it a value trap?
Here is the final authoritative verdict on GIS. General Mills is currently executing a highly expensive but completely necessary tactical rebuild. They are actively sacrificing short-term margins to protect long-term volume. Right now, it is not an unyielding fortress, but thanks to their aggressive cost-saving reinforcements and strategic divestitures, it is not a crumbling value trap either. It is a transitional asset. If their Q4 tailwinds materialize, the foundation will hold for fiscal 2027. But if inflation outpaces their 5% COGS savings, those cracks in the armor are going to widen significantly. So ask yourself, in a market where inflation is becoming sticky again, do you want to hold a company that is willingly bleeding margins just to keep its volume flat? Let us know your thoughts in the comments. Thank you for joining this Iron Financial Explainer. Don't forget to hit subscribe, and we'll see you in the next deep dive.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.